Welcome to the Daily Insights That Matter. Now, the first topic in today's DITM is all about why you might want to think twice before diving headfirst into the world of penny stocks. Sure, they might seem like a bargain, but as our ancestors used to say, you get what you pay for. And when it comes to penny stocks, that can mean high risks, low liquidity, and a whole lot of uncertainty. So let's explore why penny stocks might not be the best investment option for your portfolio. To start with, what exactly are penny stocks? Now, penny stocks refers to stocks of small companies that trade at a lower price per share, typically below rupees 10. While there is no defined range, but mostly cheaper stocks from a price standpoint are classified as penny stocks. Now, the next logical question would be, why are these stocks so cheap? Now, penny stocks are shares of those companies which have a very low market cap and they are traded at a very low price. Now, the liquidity of these stocks also is very limited and hence that makes it more risky. So why do penny stocks seem attractive? Now, many investors, especially beginners, have an inherent assumption that buying many stocks at a low price, that is buying a large quantity of shares, 300, 500, 1,000, 5,000 shares of a particular company at a low price of rupees 5, 10 or let's say even 15 is better than buying a few stocks at a high price. Now, let's look at this with an example. If an investor has 50,000 rupees to invest, they feel that buying 5,000 shares of a company whose market price is rupees 10 is better than buying 50 shares of a company whose market price is rupees 1,000. Now, they assume that if the price of such penny stocks increase by 5 or 10 rupees, then they might make a significant profit as they hold a large quantity of these shares. Hence, they feel buying a penny stock in large quantity is good. However, that's not true in reality. If you notice, in my previous example, we only spoke about the price of the stock and not the value of the stock. In crude terms, we've not spoken about the reasons for the penny stock's price to rise from the current price of rupees 10 to a price of rupees 15 or 20, and hence the hope that the stock will rise by 5 to 10 rupees is nothing but a mere speculation. While we've looked at why penny stocks seem attractive, let's look at the risks involved by investing in penny stocks. First is the lack of liquidity. Penny stocks are often traded on smaller exchanges, which can make it difficult to sell them quickly if you need to. Now, this lack of liquidity can also lead to a high bid-ask spread, meaning you may have to pay a higher price to buy the stock or accept a lower price when selling it. Now, the lack of information is the second issue. Penny stocks are often issued by smaller, less established companies that may not be required to provide the same level of financial reporting and disclosure as larger, more established companies. Now, this can make it difficult to obtain reliable information about the company's financial health and the prospects, which can make it challenging to make informed investment decisions. The third is the high volatility. Penny stocks can be highly volatile, meaning that their prices can fluctuate widely in a short period of time. Now, this volatility can be driven by a variety of factors, including market sentiment, news events, and changes in the company's financial situation. Fourth is the possibility of fraud. Penny stocks are sometimes used in pump and dump schemes in which unscrupulous promoters artificially inflate the stock's price by spreading misleading or false information, and then they sell their own shares at a profit once the price has risen. Now, this can leave unsuspecting investors with losses. The fifth is the lack of diversification. Investing heavily in penny stocks can leave you with a portfolio that is not well diversified, which can increase your overall risk of loss. Now, overall, investing in penny stocks can be a high risk, high reward proposition, but only on paper. While a handful of investors have made substantial profits by investing in these stocks, most have lost money. It is important to note that the probability of getting rewards is extremely less. Maybe 1 out of 10 penny stocks could be rewarding, and hence we would recommend investors to stay away from penny stocks. However, if you still wish to tread on the edge, we would want to highlight the importance of thorough research, being aware of the risks involved, and having a clear understanding of your investment goals and risk tolerance before investing in penny stocks. Next, we talk about the meme stock, which is back in news again for hitting a major milestone. Now, this stock has now become the 11th firm to surpass the 5 trillion rupee mark in terms of market capitalization. Let's look at which stock we're talking about. ITC has entered the 5 trillion rupee market cap after a stellar performance in the last 1 year. Now, the other companies that have achieved the 5 trillion rupee feat before this are Reliance Industries, TCS, HDFC Bank, HDFC Limited, Infosys, ICICI Bank, Hindustan Unilever, Life Insurance Corporation of India, State Bank of India, and Bharti Airtel. Now, ITC has delivered 55% in the last 1 year, whereas Nifty has given a single-digit return of 2.5%. ITC started off as a cigarette company initially and then decided to expand into other territories. Now, the stellar performance for ITC in the post-COVID era was driven by good recovery in its core cigarette business and a steady double-digit growth in the other verticals such as FMCG, hotels, and PPP, which is the paper and packaging business. Now, investors have resorted to ITC as it is considered a defensive stock due to the company's consistent performance, stable cash flow, and healthy dividend payout. Despite inflationary pressures and an uncertain demand environment, ITC has delivered resilient returns. So what does ITC's news mean for you? While ITC was a stagnant stock and meme-driven stock struck at the price levels of Rs 200 during the post-COVID period, there is a realization that patience pays off and you will reap the benefits when you hold on to a company with sound fundamentals. This will therefore have an indirect neutral impact on you. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.